Business 101 students, the beginning of week 5 here at EC3 Spring, first 8 weeks. All right, so this week I will be updating your grade book in the next day or so. I realize the grade book is a little behind. Do not panic. I'm going through all of the exams as we speak, and hopefully I will have those all graded here in the next day or so. Now, moving forward, make sure that you are working on your project with your company, and you are thinking about some of the items relating to your company. The other thing is this week we have no discussion, but I do have a video for you, a short video on Warren Buffett. This week we are looking at chapters 9 and 10 in the Business 10 textbook. And if you go into, week 5 should be visible to you. For some reason, I am in Blackboard and I am double checking that it is visible to you. Chapter 9, Finance, Acquiring and Using Funds to Maximize Value. So in Chapter 5, when you go through and you are looking at not only the chapter, once you read the chapter, but then you also review the PowerPoints, you will see how, kind of gives you an overview of how firms acquire assets and how they use finance in operations. And this finance portion of the course, right? When we talk about financial management and maximizing the value of the firm to its owners, this comes into play when we're thinking about publicly traded companies, right? So the shareholders are the owners. So if you own a share of any stock, a share of Apple, you are technically an owner. You own one share, right? And so when we talk about finance, not only from an entrepreneurship standpoint and from a sole proprietorship, limited liability, but we also look at it from a shareholder standpoint and figuring out, right, finding the best sources to secure money or funding, and also then how to use your the finance resources that you have in the most effective way. So that is really the goal of the finance department, or from being fiscally conservative. Is another way of looking at how a company might manage its funds. You will also, in Chapter 9, start to talk about risk, right, and the degree of certainty that is around a decision. And so one of the things we think of is that if you get involved in a risky stock, there might be this reward that would, or return that would come from it maybe panning out, but if it doesn't, the likelihood of it not panning out is also high. So this idea of the risk-return trade-off and thinking about that. There are a few things in here when we talk about ratio analysis, and the chapter mentions what a liquid asset is, an asset that can quickly be converted into cash. So when we think about accounting, we list items in order of liquidity, and the most liquid, meaning something that you can transfer into another item, would be cash, right? Accounts receivable are also fairly liquid. Something that would be like a building or land is not as liquid, right? Because we don't know how quickly it would sell. And we also, because there's a market there, we don't know exactly what we'll get for it. If you have a $100 bill, even though I know with inflation, we don't know we can get for $100 anymore, right? Or $20. But still cash, you can go places and convert it to something else, right? You can't necessarily convert if you have vehicles, right? If you're a business and you have multiple vehicles in your fleet, you can't necessarily convert those into cash or trade those, right? The whole idea of liquidity is something that is easily transferable into cash. Now, there are a few other ratios that we look at, leverage ratios, right? Measuring the extent to which a firm relies on debt financing, meaning how much are they in debt? So if we were thinking about from an accounting standpoint, if the firm is worth $2 million, right, a company is, but maybe the company is in debt $1.8 million. So there's a lot of debt to what it overall is worth. But maybe a company that's worth $2 million only has $300,000 in debt. There's a lot more equity there then. So we think about that from a leverage standpoint. Income statements, right? There's a couple, just go through those budgeted statements. There's a couple other short-term financing, try to look into those. Revolving credit. long-term financing, right? So not only do we have some short-term options, we also have long-term ways of generating money. Capital structure, the mix of equity and debt financing a firm uses. Financial leverage, it goes into that. Don't spend too much time on that pros and cons of equity financing. I mean, go through it and read it, but I want you to focus a little bit more on like acquiring and managing current assets. Make sure that you have an idea of what a treasury bill is. A certificate of deposit, most of you know what that is. Also, this part, review the present value and net present value, right? So if we think of a dollar today, I think this is one of your questions for homework. How is a dollar that you're given today worth more than a dollar you're giving a year from now, right? So think about the net present value. And so really it's about finance, this chapter, chapter 9. Chapter 10, see, I'll pull this up. So you'll go through, read the chapters, and then go through and review the PowerPoint and how it coordinates with the chapters. Take a look at Warren Buffett's video and his suggestions for investing. Hopefully all of you are having a good week, right? So chapter 9, the finance chapter, and then chapter 10, one of my favorite chapters, financial markets, allocating financial resources. So I used to teach markets classes, but I haven't taught, we don't have any here yet, but they are pretty exciting, studying how the markets operate. If you like video games, right, and you like that fast-pacedness of trying to, capture coins or find doors and going into other worlds, or I'm not a video game player, right? So, but if you like that fast pace and you like studying video games to figure out quicker ways to get through worlds and whatnot, you might like the financial world, right? So being a financial trader or an analyst, it's a very kind of fast paced, and you have to be up on whatever industry you're in, whatever funds you're looking at. But talking a little bit about financial markets, there's several types of, when we think about banking, we think about taking money from savers and loaning it out to borrowers. And so there are a couple ways we can do that. The commercial banks are for large corporations, credit unions owned by the depositors, and savings and loan associations. So banks that we use locally come in one of those two forms, savings and loan association or credit union. Some of you may be a member of one of those, or you may have money in one of those or in both, right? So they're just a little bit different structure, even though both pay similarly. I know we have a couple local credit unions that you are a technical part owner if you take deposits. They're in a few different ways of borrowing than versus a traditional savings and loan. A couple other non-depository places that basically use funds, these investment banks, security dealers, just to name a few, security brokers. There are a few laws that I just want you to be aware of relative to financial markets. The Federal Reserve Act of 1913 set up this thing called the Federal Reserve System, and there's a central bank then that governs banking. You probably heard of the prime, prime amount, right? And interest rate changing, and the Fed or the Federal Reserve either raising interest rates or lowering interest rates to try to stimulate or stimulate the economy or slow inflation, things like that. Let's see, in 1933, the Banking Act that established the Federal Deposit Insurance Corporation. So that's the FDIC. If you go into a bank, you should see FDIC, and I believe it's up to $250,000 per account at the bank that you're insured for. So if something were to happen and the bank were to close, the federal government actually insures your money. This was put into place after the crash of the market and the Great Depression. So that's the Banking Act of 33. And the Securities Act of 33 also, in that same year, established the Securities and Exchange Commission, which basically oversees IPOs and overseas companies that want to go from private to public. And if they are publicly traded, they make a list of things that you as a publicly traded company need to basically reveal to any of your owners. And so when I talk to you about your companies, and if you go to your company's website and you look for that section that says investors, and you find that annual report is governed by Securities and Exchange Commission, because you can bet that companies don't want to reveal what they're planning, how they did, right? They don't want their competitors to know, but they have to reveal a certain amount, and those minimums are met in that annual report, and that is due to regulation by the Securities and Exchange Commission. What else? Types of securities: common stock, preferred stock, bonds. Take a look at those. Let's see. Mutual funds. Some of you may have mutual funds. Capital gains. In this chapter, we learn about capital gains. Return on investment received if the price of stock rises above the amount paid for it. So sometimes you get taxed on capital gains. Bonds. So there's a little section on bonds here. The difference between a primary and secondary market. Primary market, when we see something like the IPO, typically most of us are, when we are buying stocks, we are in the secondary market, meaning they have already been bought and sold at least once. Let's see. If you have an account with Charles Schwab, E-Trade, there are things you can put in there. You can put in market orders or limit orders if you've ever played around in there. Maybe you already do this, right? Market orders tell brokers to buy or sell specific security at the best price available. So I would go in and say, I would like 100 shares of Apple, whatever it's selling for, find it and buy it, right? Or you can do a limit order, which would say buy a stock if it gets below a certain level. Okay, if Apple gets below, I'm just going to leave a standing order for if Apple gets down below, well, who could we pick? I don't even know what Apple's trading at right now. And I'm going to find out for you. As of today, let's see what Apple is trading. Apple is at, as of March 6, 115, 155.17. So maybe I'll put a limit order that if Apple gets down below 140, I want to buy 100 shares, right? And so if it's currently trading at 155, if I wanted to put in a market order, I would put that in, and typically would be somewhere around that 155 range. I could put a limit order in that if something ever drops, it's automatically purchased and I don't even have to watch for it. You can also put a limit order into your limit sell if you wanted to sell a stock. So say you have a stock and it gets to a certain price, right? Maybe you want to sell it, so you can put those. There's lots of different controls that you can put on your using those self-service tools, right? You can also use through a broker. You can use those as well. You can tell your broker, right? Let's see what else is. Different types of investing. Some of you may have investments. You may have 401ks that they required you to pick, different things. Do you want to invest in stocks that are undervalued? Do you want to, is that your main goal? Do you want to invest in emerging markets? And there might be a mutual fund that is a collection of emerging markets, those types of things. The indices, most of you have heard of the Dow Jones Industrial Average, tracks the stock prices of 30 large, well-known U.S. corporations. They have to meet a specific guideline, and there are always one or two that might be changing out, right? So same with Standard & Poor 500, based on the price of 500 major corporations. There are some major stock price indices around the world. The Wilshire 5000 is also important. The Russell 2000 is important. The FTSE 100, that's the London Stock Exchange. The Nikkei, that's the Nikkei 225 Tokyo Stock Exchange. SSE Composite, that's the Shanghai Stock Exchange. So these are just different indices that kind of give you a little bit of a picture of what's happening in those marketplaces. So that is chapter 10 when we talk about markets. And so that is 9 and 10. And then you have 2 homework assignments and then a short video, how to invest for beginners, 3 simple rules. And so that is what we are working on. I will work to get your grade books updated, so please be patient there. Again, if you ever want to, you know how to get a hold of me, right? Via email, crobertson@ec3pa.org, or via text, 814-490-6473. I am also on campus Tuesdays and Thursdays on the West Campus. If you would ever like to meet in person, I am there every other Wednesday as well, and I can meet by appointment if that interests you. Let's see, what else? Thank you for all your hard work. We are over the hump, and we are into week 5. So hopefully you are all staying caught up, and I will get caught up on your grade book so you are a little bit more secure there, and then we will keep pushing forward. So have a wonderful afternoon. It is Monday 3/6. 2023, and we are entering now into, this is the 5th week of our 8-week course.